Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. It is Saturday, January 17th, 2026, and we are kicking off this investing year with focus, analysis, and a real hunger to uncover some serious market inefficiencies. Today, we're breaking down one of the most interesting and honestly one of the most controversial companies on the market right now, the creative software monopoly Adobe Inc. On the surface, this is the company that practically invented digital creativity. I mean, Photoshop, Premiere, these are verbs now. But the real question for us as long-term investors is this. The market is currently pricing this company as if it's a melting ice cube, a legacy tech giant about to be crushed by generative AI. But then you look at the financials, and they tell a story of a cash flow machine that's just eating its own shares at a record pace. The question we need to answer today is simple, but frankly terrifying. Are we looking at the bargain of the decade, or are we staring at a buggy whip manufacturer in 1910 right before the Model T rolls off the line?
That is the multi-billion-dollar question, isn't it? And, I mean, the stakes feel incredibly high on this one. Before we tear apart the balance sheet, a quick heads up for the audience.
Right. If you are looking to take a position on this or anything else we discuss, we use Interactive Brokers for our execution. Use the link in the description for a stock bonus when you sign up.
It is the best way to get a bonus, ensure best execution, and support the channel at the same time. Really helps us out.
And while you're there, please like, subscribe, and let us know your thoughts in the comments. Is Photoshop dead? Let's argue. I'm really curious to see the debate on this one.
Now let's get into it. Pillar number 1, the valuation dislocation.
Okay, let's unpack this because the numbers we are seeing right now are genuinely shocking for anyone who has followed tech for the last 10 years. We are looking at a stock price hovering around, what, $304, give or take?
304 and change, yeah.
Yeah.
Which puts the market cap at roughly $137 billion.
But the headline here, the thing that made us stop and say we have to do a deep dive on this, is the drop. The stock is down roughly 20% year to date, and it's only January 17th. That's a brutal start.
It's a bloodbath. And that price action is what brings us to the core of the issue, the multiple compression. We are looking at a trailing 12-month PE ratio of 18.2x.
18.2 for Adobe. It feels wrong to say out loud. I mean, when I think of Adobe, I think of high-flying, best-in-class software. I don't think of multiples that look like a regional bank or, I don't know, a utility company.
Exactly. Feels like a glitch in the matrix. To put that into context, and this is the really important part, if you look at Adobe's 5-year average, this stock typically trades at around 40 times earnings.
40. So we're talking about a multiple that's been more than cut in half from its historical average.
Cut in half. So right now, today, it is trading at a massive discount, not just to its own history, but to the entire software peer group. And it gets even more extreme. If we look forward, using the next 12 months consensus, we're looking at a forward PE of roughly 16.8x.
16.8. Based on what, about $18 of GAAP earnings for fiscal year 26?
That's right, based on the consensus EPS of about $18. So the market is pricing it for even less growth going forward than it had in the past.
So what does this all mean? When you see a company that has been an untouchable compounder for 2 decades suddenly trading at 16 or 18 times earnings, the market is screaming something at you. It's not a quiet signal. It's a foghorn.
It is a foghorn. The market is efficient enough to know what the earnings are today, but it is pricing in a disaster for tomorrow. The market is betting on terminal decline, or at the very least, a structural reset in its growth profile.
So it's saying the growth is just gone.
Gone or worse. When you price a software monopoly at 18x, you are essentially implying that growth is going to slow to GDP levels, 3 or 4%, or, and this is the darker theory,
Here it comes,
that the terminal value of the company itself is at risk. This is the melting ice cube theory. The market thinks the entire business is just going to slowly fade into irrelevance.
Which brings us to the narrative, right? This isn't just about interest rates or a bad quarter. This is a very specific bet that generative AI is going to destroy this company's core business.
Absolutely. The story has completely flipped. Adobe has shifted from a growth at any price darling to a show me stock.
The premium is completely gone, wiped out.
That is the setup. We have a massive dislocation between the historical valuation and the current price. But to understand if the market is wrong, we have to understand what is actually being valued here. We need to look at the engine itself.
Right. Pillar number 2, the business engine and the moat assessment. Let's start with the basics because it's an incredible model. At its core, this is classic SaaS recurring revenue.
The gold standard.
You have your B2B enterprise clients and then your prosumers, the freelancers and small studios, paying $59.99 a month for the all apps plan.
And historically, retention has been north of 90%.
Which is just phenomenal. It's because, let's face it, if you are a creative professional, these tools, Photoshop, Premiere, Illustrator, they aren't optional. They are mission critical. You can't do your job without them.
But we need to go deeper than just recurring revenue. That's table stakes for a good software business. We need to talk about the moat. And I would argue that Adobe possesses arguably the strongest switching costs in the history of the software industry.
Okay, that is a bold claim. Stronger than Microsoft Office. Stronger than, say, Salesforce for a big company.
I think so. And here's why. It comes down to two very distinct, very powerful types of lock-in. First, you have what we call procedural lock-in.
Procedural lock-in. Break that down.
Think of it as muscle memory. There are millions of designers, editors, and artists around the world who have hardwired Adobe's hotkeys and user interface into their fingers. It is subconscious at this point.
I know exactly what you mean. I have a friend who is a video editor. He doesn't even look at the keyboard when he's in Premiere Pro. His hands just fly. It's like he's playing a piano.
Exactly. That is the procedural lock-in. Now imagine a company wants to switch its whole design department to a competitor like Canva or Affinity to save a few bucks a month. They aren't just paying for new software licenses. They are paying a massive productivity tax.
Because they have to retrain their entire workforce.
You have to retrain everyone, slows down output, which kills deadlines. Companies hate slowing down output. It destroys their operating margins.
That makes perfect sense. It's like trying to switch from a QWERTY keyboard to a Dvorak keyboard. Even if the new one is technically more efficient, the friction of relearning is just too high for most people. You just won't do it.
You won't do it. The cost of switching isn't measured in dollars. It's measured in lost time and brain damage. And then the second layer, which is maybe even stronger, is relational lock-in.
Okay.
The file formats themselves. PSD for Photoshop, AI for Illustrator, INDD for InDesign. These aren't just files. They are the industry standard lingua franca.
The common language of the entire creative world.
The common language. You literally cannot collaborate in the professional creative supply chain without Adobe. If you are an agency sending a file to a printer or a freelancer sending a logo concept to a major corporation, it has to be an Adobe file.
If you send something else, the whole supply chain just breaks.
It grinds to a halt. It's a network effect so powerful that it creates a de facto monopoly on professional collaboration.
However, and here is where it gets really interesting for us as investors, we are starting to see cracks in that fortress. We talk about pricing power a lot on this show. It's one of the key signs of a great business. In 2024, Adobe pushed price hikes of 6 to 9% across its major regions.
And usually that is a sign of incredible strength. It shows you can command a premium and your customers will just pay it.
Usually. But the reaction this time felt different. I'm seeing what I'd call grudging compliance. It's not loyalty anymore. It feels more like hostage taking.
That's a great way to put it. The backlash, especially online, suggests they have hit the ceiling. They cannot just keep raising prices by nearly double digits without losing volume, or at the very least, a massive amount of goodwill.
Right. And that's a critical distinction, isn't it? True pricing power, in the framework we use, is the ability to raise prices without that volume loss and without enraging your customer base.
Yes. If user sentiment shifts from, I love this tool, it's worth every penny, to, I hate that I have to pay for this, you create a massive opening for disruption. You are eroding the emotional capital you've built up with your users over decades.
And that disruption is happening. It's happening at the low end of the market. This is what we call the anti-mode.
The anti-mode, I like that.
You have Canva on one side, which is just eating the low end and the consumer market for breakfast. And then you have the generative AI tools like Midjourney and OpenAI's Ally on the other. They're both acting as counter-positioning.
Yes. For a long, long time, the barrier to entry into creative work was the steep learning curve. You had to study Photoshop for years to make something look professional. That complexity protected Adobe.
It was a feature, not a bug.
It was part of the moat. Now, a non-professional, a marketing manager, a small business owner can create good enough assets with a simple text prompt or a drag-and-drop interface. This directly attacks Adobe's potential growth engine, the next generation of creators. They might hold on to the high-end professionals for now, but they are at risk of losing the funnel of new users who are starting their creative journeys elsewhere.
Which transitions us perfectly to the elephant in the room. The reason the stock is getting hammered. Pillar number 3. The AI existential threat. We need to do a pre-mortem here.
I love this exercise, the inversion mental model. It's a classic Mungerism.
Exactly. Let's assume it is 2036, 10 years from now, and Adobe has gone bankrupt. Or maybe not bankrupt, but it's a shadow of its former self. How did it happen? Walk me through the obituary.
Okay, let's play that out. The fundamental shift, the thing that will have to happen for Adobe to fail, is that creation itself became a commodity.
The act of making something new is no longer a specialized skill.
Precisely. The mechanism of failure would be a paradigm shift in the fundamental workflow. Currently, Adobe owns what we call process power, the ability to edit pixels, manipulate layers, fine-tune vectors. It is an editing suite.
You start with a blank canvas or a photo and you edit it.
Right. But if the paradigm shifts so that a complex, layered, production-ready image is generated fully formed from a single text prompt, the need to edit pixels just evaporates.
The workflow moves from editing to generating.
And if you don't need to edit, you don't need Photoshop, you don't need Illustrator, the entire Creative Cloud becomes a legacy tool.
That is the nightmare scenario for shareholders. If the AI gets so good that the first output is the final output, the middleman, which is Adobe, is cut out of the process entirely. But Adobe isn't just sitting there waiting to die, are they? They have a defense strategy, which brings us to the concept of reflexivity.
Reflexivity is a fascinating concept here. In this context, it means Adobe is trying to embed its own AI, which is Firefly, inside the existing workflow to change how the user interacts with the tool, and, they hope, keep them locked in.
Can you break that down? What does that actually look like for the user?
Sure. So instead of you going to a third-party tool like Midjourney to generate an image and then having to download it and drag it into Photoshop to fix it,
Which is what a lot of people do now.
it's the current workflow for many. Adobe's strategy is to put the generation bar inside Photoshop. They're trying to make the AI a feature of their software rather than a replacement for it.
So they are trying to co-opt the threat to absorb it into their own ecosystem.
Their goal is to ensure that the value of AI accrues to the incumbent, that's Adobe, rather than to the model provider like OpenAI. They want to own the last mile of creativity.
The last mile. Explain that.
They are betting that even if you generate a great image with a prompt, you will still need to tweak it, composite it with other elements, adjust the colors for your brand, and prepare it for final production. They want to be the indispensable platform where that finishing work happens.
They're trying to create a Lollapalooza effect.
Now, there is a Charlie Munger term. I'm impressed.
I try to keep up. But seriously, the Lollapalooza effect is when multiple forces all push in the same direction to create a massive nonlinear result. Historically, Adobe won by combining standardization schools teaching it with the network effects of their file formats, plus the scale from their massive R&D budget.
And now they're trying to force AI into this same loop. The pitch is, use our AI, Firefly, because it's commercially safe, it's deeply integrated, and it's already inside the tool you've spent your whole career learning.
It's a powerful argument.
It's the bull case for their strategy.
Well,
But there's a soft power issue here that we cannot ignore. A cultural problem. We looked at the Glassdoor sentiment and inside view data regarding the company culture.
and it is mixed, to be polite about it. A lot of employees feel the company is becoming a feature factory.
What does that mean, a feature factory?
It means there's a sense that they are rushing AI tools out the door to please Wall Street, to show that they're doing AI, rather than deeply thinking about and solving actual user problems. It's reactive, not innovative.
And this ties into the trust bank with customers, which is running dangerously low. Do you remember the terms of service controversy from a while back?
Oh, absolutely. The one where the language made it sound like Adobe was claiming rights to user content to train their AI models.
Yeah.
The creative community was in an uproar.
They were furious.
Yeah.
That, combined with those aggressive cancellation fees,
Yeah.
it has severely damaged the brand's effective valence.
Effective valence. Look at you getting technical.
Yay, it matters. It's a real metric. It measures the emotional connection to a brand. Is it positive or is it negative?
And right now, for Adobe,
For a lot of creatives, it's trending negative.
Yeah.
And that's the danger. Users are staying because they have to, because of the lock-in we discussed, not because they want to.
that is a very dangerous position to be in when a paradigm shift is occurring. If a viable alternative ever appears, one that's good enough, they will leave in droves. There's no loyalty left.
So we have a threatened moat and a terrified market. But let's look at the actual numbers, because this is where the value trap argument starts to get really complicated.
Right. Pillar number 4, financial resilience and capital allocation.
If you just ignore the stock price for a minute and open up the financial statements, this company is an absolute fortress. The quality of earnings is elite. We're looking at GAAP operating margins for fiscal year 2025 at around 36.6%. Non-GAAP is approaching 46%.
46%. That is absolutely massive. It just shows the incredible scale economies of the business. Every incremental dollar of revenue flows almost entirely to the bottom line. It costs them virtually nothing to sell one more digital subscription.
It's a beautiful thing. However,
Yeah.
we have to do a reality check on those earnings. We can't just take that non-GAAP number at face value.
Here we go. The SBC discussion.
The dreaded stock-based comp. There is a significant gap between the adjusted EPS of $20.94 and the GAAP EPS of $16.70.
That gap, about $4.24 per share, is largely SBC.
And this is something so many investors, especially in tech, just gloss over. Adobe, like many others, treats SBC as a non-cash expense in their non-GAAP numbers. But if you are a shareholder, that is a very real cost. It's dilution. They are printing new shares to pay their employees.
And it's not a small number here.
Not at all. It is running at about 23% of operating cash flow. That is high. It means the real free cash flow available to common shareholders is lower than the headline number implies, because a big chunk of that value is being transferred to employees, not to you, the owner.
But, and here is the powerful counterpunch to that argument. The company knows this, and they have entered what I like to call uber cannibal territory.
This is the part of the thesis that is most compelling to me as a value-oriented investor. It's where things get really interesting.
Let's look at the buyback velocity. In fiscal year 2025 alone, Adobe repurchased roughly 30.8 million shares.
And the total float and the number of shares outstanding is around 450 million.
So do the math on that. That is a 6 to 7% reduction in the total share count in a single year.
And the beauty of it is the price they're doing it at. Buying back your stock at 40 or 50 times earnings is questionable. You might be overpetsing.
But buying back stock at 18 times earnings, that is highly accretive to the remaining shareholders. It provides a huge boost to EPS.
It's the definition of rational capital allocation. They are literally eating their own share count to drive value.
And let's not forget the core profitability metric. The returns on invested capital, the ROIC, are sitting at 27 to 30%.
Which vastly exceeds their weighted average cost of capital, or WACC, which is around 12.5%.
So for every dollar of capital they deploy back into the business, they are generating substantial returns. This confirms they are still a compounder.
Absolutely. The engine is still incredibly efficient.
There is also an interesting twist of fate here regarding M&A that we should touch on. Remember Figma?
Oh, how could we forget? The $20 billion acquisition that regulators blocked. A huge drama at the time.
At the time, the market panicked that the deal failed. The narrative was, Adobe is dead, they can't innovate, they have to buy their growth. But in hindsight, was that failure actually a massive win for shareholders?
I believe it was a blessing in disguise, a huge one.
Why?
Well, for one, it saved shareholders $20 billion of capital.
Yeah.
That cash is now being used for these enormous buybacks at a cheap valuation.
A much better use of capital, arguably.
And maybe more importantly, it forced management to build Firefly internally rather than just trying to buy innovation. It imposed discipline. It forced them to exercise their own engineering and R&D muscles again, which is a healthy thing for a company in the long run.
So they have the cash flow, they are buying back shares hand over fist, but the market absolutely hates them. This brings us to the final part of our analysis. Pillar number 5, valuation and the final verdict. How do we actually price this thing? What's it worth?
Okay, so we need to triangulate the intrinsic value. We can't just rely on one metric, especially in a situation this fluid. I like to use 3 different methods. Method A is historical mean reversion.
Walk us through that. What's the logic?
The logic is that while narratives can swing wildly, valuations for high-quality businesses tend to revert to a long-term average over time. So if we assume the AI panic calms down and Adobe reverts to, let's say, a conservative 25x PE, and remember its 5-year average is 40x, so this is a massive haircut.
Right. You're not even assuming it goes back to the old highs.
Not even close.
Yeah.
So 25x on $18 of consensus earnings, that gets you a stock price between $450 and $500.
Right. So that suggests pretty significant upside from today's price of $304. That's a 50% gain just from a sentiment shift.
It's huge. Method B is simply the analyst consensus. The average Wall Street price target right now is sitting around $450.
Which matches up pretty well with your first method.
It's right in the same ballpark. Now, method C is the most conservative one, and my personal favorite. Owner earnings or a discounted cash flow model.
The real fundamental value.
The fundamental value. If we take their free cash flow per share of roughly $22, assume a very conservative growth rate of 8%, which is below their own guidance, and then apply a 10% discount rate, we get an intrinsic value of roughly $340 per share.
So even in your most conservative model, it is still undervalued from where it trades today.
That's right. So when you put it all together, my analysis places the deep value buy zone for this stock somewhere between $280 and $310.
And with the current price at $304, we are sitting squarely in that zone.
Smack dab in the middle of it.
But we have to do this. We have to play devil's advocate. We have to do the red team challenge. I want you to look at me and tell me why all of that analysis is wrong. Why is this a trap? Convince me I am buying a buggy whip manufacturer in 1910.
Okay. Here is the bear case, stripped of all the politeness. You are buying a legacy asset. That cheap 18x PE is an illusion, a classic value trap, because the earnings, are about to collapse.
Okay, how? Give me the mechanics of that collapse.
The seat license model is dead. That's the mechanism.
Okay.
Right now, a big marketing department might have 50 designers, and each one has a $60 a month Creative Cloud subscription. That's your revenue base.
Right.
In 5 years, with truly powerful generative AI, that same department might shrink to just 5 AI prompters. They will produce the same amount of work, maybe even more, but they will only need 5 licenses, not 50.
Ouch. That is the volume collapse we talked about earlier, a 90% reduction in seats.
Exactly. And if your seat count contracts by 30, 50, maybe even 70%, that incredible operating leverage we talked about works in reverse. Revenue plummets, but your fixed costs for R&D and sales stay high. Earnings could easily collapse by 50% or more. And in that scenario, paying 18x earnings today is actually making 36x or more on future shrunken cash flows. You are catching a falling knife.
That is a terrifyingly plausible scenario, and it is absolutely what the market is pricing in right now. But let me offer the bull rebuttal. I think that view completely ignores the last mile problem.
But why?
Yes, AI will generate a ton of content. But have you ever tried to use a raw generated AI image for a global marketing campaign for a Fortune 500 company?
It's not that simple.
It's impossible. The hands have 6 fingers, the logo is slightly warped, the vectors aren't scalable, the lighting is a little off-brand. You still need a human professional to take that raw material, to layer it, to color correct it, to vector it, and to make it perfect. Adobe doesn't sell raw materials. It owns the assembly line. The AI is just a new, cheaper raw material supplier.
And that's the whole debate in a nutshell, isn't it? Is
Yeah.
AI a supplier or a replacement?
Exactly. And the valuation today gives you a massive margin of safety. At 18x earnings, you are priced for the buggy whip scenario. You are priced for failure. Any stabilization, any sign that AI is actually a tailwind that helps professionals work faster, not a headwind that replaces them, re-rates the stock to 25x instantly.
So bringing it all together for the outro, what is the final synthesis here? What are the scores?
I'll give the quality score an A. The moat is under attack, there's no doubt about that. But that procedural and relational lock-in for the enterprise is still incredibly robust.
I agree with that. And for valuation, I have to give it an A. It's a rare dislocation. Finding a near monopoly with 30% ROIC trading at 18 times earnings is something you see maybe once or twice a decade.
For me, the final takeaway is that the uber Cannibal buyback is the ultimate safety net. Even if revenue only grows at 10%, those aggressive share repurchases will drive mid-teens EPS growth for shareholders. The math is just powerful.
It is.
Here is my final provocative thought for everyone listening. The market thinks Adobe is Kodak, the film company that missed the digital revolution. But Kodak didn't have 46% operating margins and a share count shrinking by 7% a year while it was dying. The bet here is simple. Is human creativity over? Is the need for professional refinement of ideas completely obsolete? If not, then Adobe is on sale. If yes, well, we all have much bigger problems than our portfolios.
That really puts it in perspective. A fantastic summary.
Thanks for watching Synaptic Investing. Check the link for Interactive Brokers in the description, smash that like button, and we will see you in the next deep dive.
See you next time.